Welcome to lesson 1.2 on accounting process or accounting cycle. I'm CPA Paul Gaido, and kindly remember to share and subscribe this video. Our lesson's objectives are to recap on the definition of accounting and to have a detailed analysis of the accounting process, starting from the source document, journals or daybooks, ledgers and the ledger accounts, trial balance and the adjusted trial balance, financial statements and reports, and finally, financial and statistical ratios. In lesson 1.1, we defined accounting as a systematic process of correcting, recording, classifying, summarizing, communicating, and interpreting financial transactions in an entity for use in decision making. Therefore, accounting process, which is also known as accounting cycle, begins at collecting financial transactions, which is done through source documents, then recording them on the journals, classifying them on the ledgers and the ledger accounts, then summarizing through trial balance and adjusted trial balance, and communicating financial reports and financial statement, and finally, interpreting through ratio analysis. Source documents. Accounting process begins at source document. A source document is a record that is kept as an evidence to support financial transaction. For instance, a cash sale is supported by a cash sale receipt. A credit sale is supported by a customer's invoice. A credit purchase is supported by a supplier's invoice. A cash payment is supported by a payment voucher. An internally incurred expense is supported by a claim. Payment of salaries and wages is supported by an employee's payslip. Deposit of cash and check to banks is supported by a banking slip. The second process in accounting cycle is preparation of journals. Journals are also known as day books, books of original entry, or prime books. A journal is a diary for registering financial transaction records. Examples of journals are sales journal for recording customers' invoices, sales returns journal for recording credit notes to customers, purchases journals for recording suppliers' invoices, purchases returns journal for recording debit note to suppliers, cash receipt journal for recording cash receipts, cash payment journals for recording payment vouchers. The third process in accounting cycle is preparation of ledgers and ledger accounts. A ledger is a book of accounts that have been grouped together. On the other hand, a ledger account is a separate record within the ledger that contains specific categorized record of business transactions. The fourth process in accounting cycle is preparation of trial balance and end of year adjustments. A trial balance is a summary of all general ledger accounts balances. At the end of an accounting period, all ledger accounts are balanced off, and a summary of all balances is prepared in form of a trial balance that shows debit balances and credit balances. On the other hand, end of year adjustments are changes that require to be made on the balance sheet and the profit and loss account in order to ensure that the financial statements are accurate and shows a true and fair view of the state of affairs of an entity. The fifth process in an accounting cycle is preparation of financial statements and financial reports. A financial statement is a summarized report of an entity that communicates either its financial performance for a particular period or its financial position as at a particular time. The last process in accounting cycle is interpretation of financial and statistical ratios. Ratios are used in interpreting the accounting transactions and the financial information. Financial ratios can be grouped into 6 categories. That is, capital adequacy ratios that shows how solvent an entity is to meet its overall financial obligations, asset quality ratios that shows the quality of operating assets, management efficiency ratios that shows how efficient an entity is to generate turnover, earning ability ratios that analyzes the profitability of the entity, liquidity ratios that shows the ability of the entity to meet its short-term financial obligations, and sensitivity to market risk that shows the entity's growth of shareholders' value and returns. Since we are discussing about a process in accounting, let's have an analysis of SPOC model. SPOC is an acronym for supplier, input, process, output, and customer. Supplier is the source of the input. In accounting, the input may come from creditors, debtors, employees, and lenders. Inputs are the ingredients required for a process. In accounting, the inputs are recorded in the source documents such as receipts, invoices, and vouchers. A process is a series of steps or procedures undertaken to achieve a particular end. The accounting process involves making journal entries, posting the journal entries into the ledgers, balancing the ledger accounts, summarizing the ledger account balances, making end-of-year adjustments, preparation of financial reports and statements, and computation of financial ratios. Output is the achieved target or the result of the process. The outputs of the accounting process are financial reports, financial statements, and financial ratios. Customers are the client who receive the output of a process. In accounting process, customers are the users of accounting information. The users of accounting information includes shareholders, managers, and lenders. In accounting process, records are generated and stored to document the data collected, the procedures followed, and the information presented. Lastly, in every accounting process, there must be internal controls applied. The controls implemented should safeguard the confidentiality, integrity, and availability of documented information. Thanks for watching. Remember to subscribe our channel, Treatise of Accounting Information Systems. Like this video, leave a comment, and share with others.